Section 6 disclaimer. The My Ex Thought Chaos. Listen up, Loduin legends. I've got a question for you before we start. Do you believe in intelligence? Or are you like my ex who thought 500 will always be 500 no matter how much chai, beer, or petrol it buys? Yeah, my ex also thought loyalty was forever. Guess what? She cheated. And guess what happened next? Boom. Karma bitch. Car accident. By the way, I'm sitting at the car service station right now getting my ride fixed. So technically, even my car is more stable than your purchasing power. Inflation is that toxic X. Looks harmless at first. Oh, just 2% per year. Then one day you wake up, onions are luxury items, your salary feels like pocket change, and your savings account is basically a joke. So no, this is not financial advice. This is me dragging central banks, governments, and every chomu who thought money printing equals free prosperity. If you still think like that, congrats. You've joined my ex in the Hall of Dumb Decisions. Welcome to Valhalla Economics, where currencies burn faster than Kardike's relationships and legends actually pay attention. Section 6, Introduction. Chaos mode on. So my ex, the same genius who thought loyalty was a lifetime warranty, once told me, one day we need to switch off all the internet and servers because technology is bad. Bruh. She couldn't even open a Gmail without calling tech support, but suddenly she wanted to Thanos snap the internet out of existence. And that's exactly how most of you Lodu think about the stock market. Oh, brew, I'll invest today and become rich tomorrow. No, you dumbass. If it was that easy, Sudhanshu Chutia would already be Elon Musk by now. But guess what? He's still crying over his Zeroda portfolio like it's his ex's wedding pictures. The stock market isn't some magic slot machine. It's a bloodbath, a circus, a Valhalla battlefield where only legends with discipline, patience, and actual brains survive. If you're coming here thinking one trade will buy you a Lamborghini by Friday, fuck you. You're not a trader. You're just gambling with your future like my ex gambled with her IQ. Welcome to Section 6, where we rip the mask off inflation, currency devaluation, and all the lies that keep retail clowns poor while Miss Y, the witch, laughs in your face. Buckle up. Here's the Section 6 deep dive. Inflation and currency chaos. Valhalla grade, savage, simple English, full of real takeaways, roasts for Kardike and Sudhanshu, and the X plus garage karma bitch vibe you wanted. Read it loud, laugh, learn. Don't be the clown who thinks 100 equals 100 forever. Section 6, deep dive, inflation and currency chaos. Quick preface. Remember my ex who wanted to switch off the internet because she couldn't use a computer? She cheated, then got hit by a car. Karma bitch. I'm at the car service station finishing a chai while your purchasing power is getting serviced by central banks. Now listen. What the hell is inflation? Plain. Inflation equals prices rising. More exactly, the average price level of goods and services goes up, so the same cash buys less. Don't romanticize it. A little inflation is normal. Runaway inflation is a disaster. Think 2% per year, annoying, versus 1,000% per year. You need wheelbarrows of cash to buy bread. Number 2, how inflation is measured. Keep it simple. CPI, Consumer Price Index, basket of stuff people buy, food, transport, rent. Headline equals total. Core equals excluding volatile food and energy. PCE, personal consumption expenditures. Another official gauge. Fed prefers PCE sometimes. Producer price PPI, tracks prices earlier in supply chain, can foreshadow CPI. Break-even inflation, bond market. Difference between nominal and inflation-protected yields, market's inflation guess. Translation, watch CPI for what hurts your wallet, PPI for what will hurt your wallet next month, and break-evens for what traders expect. Number 3, why inflation happens. The simple causes. Demand pull, too much money chasing too few goods. Example, everyone has cash plus wants stuff, sellers raise prices. Cost push, supply shock, production costs rise, oil, lithium, wages. Firms pass costs to customers. Example, supply chain broken, prices up. Built-in, wage price spiral. Workers demand higher pay. Companies raise prices. Workers demand more. Loop. Monetary expansion. Central bank prints or injects too much money. QE gone wild. More currency for same output. Expectations. If people expect inflation, they act now. Buy, demand higher wages, making inflation self-fulfilling. Real roast. Kardike buys meme coins thinking infinite money because central bank printed once, then cries when real-world bread costs more. 4. Effects. Who gets screwed and who dances? Savers. Money in cash loses value. Your grandma's savings becomes sad. Borrowers. Debt becomes cheaper in real terms. Good if you borrowed fixed rate. Wage earners. If wages lag prices, living standard falls. Fixed income investors. Bondholders get crushed as yields rise and prices fall. Asset owners. Real assets, property, commodities often go up. Winners and losers change. Hyperinflation equals social breakdown. History shows collapse in trust, barter returns. Not a melodrama. It ruins lives. Number 5. Famous horror shows. Short. Weimar Germany, 1920s. Wheelbarrows of cash. Zimbabwe, 2000s. Banknotes with 10, 12 zeros. Venezuela, 2010s. Wages worthless. Shortages everywhere. Lesson. Political failures, money printing, supply shocks equals disaster. Don't be the idiot who thinks this time is different. Number 6. What central banks do. The tools, simple. Raise interest rates, cool borrowing, slow spending. Lower rates, stimulate borrowing and spending. Open market ops, QE, buy bonds to inject liquidity. Reserve requirements, lender of last resort actions. Communication, tell the market what they'll do. Credibility matters. Trade-off, higher rates equals pain for debtors and stocks. Lower rates equals cheap credit, possible inflation later. It's a policy dance, often ugly. Number 7. Stagflation, the worst buffet when inflation and unemployment both rise, supply shock plus weak growth. Stagflation. Policy is stuck. Raise rates to fight inflation, hurts jobs, or keep rates low. Inflation stays. Nobody likes it. 8. How inflation affects markets, what Miss Y does. Stocks, valuations compress as discount rates rise. Growth stocks with future promises get hit hardest. Bonds, prices fall when rates go up. Long-duration bonds suffer most. Commodities, usually rally oil, metals, food, hedges versus inflation. Currencies, weak currency imported inflation. Strong currency equals cheaper imports. Sectors winners, energy, materials, some real assets. Sectors losers, high growth, long duration tech, because future cash is worth less when discount rate rises. Roast, Sudhanshu had 90% in high growth battery memes. Inflation surprise came, and his portfolio went from rocket to grounded pigeon. Number 9, EV versus hydrogen tie-in, short and blunt. Lithium supply shocks equals cost push inflation for battery and EV supply chains. Mining environmental costs and geopolitics can jack up prices. Hydrogen R&D and CapEx are long dated. Big OEMs investing quietly means they see real use cases. Those are less noisy, less memeable, and can be better hedges for real industrial inflation cycles. If everyone hypes EVs without supply sanity, you get speculative bubbles plus real resource-driven inflation. Don't be Carta Guy, who buys the hype and ignores the supply-side receipts. Now number 10, signals to watch, practical. Copy these. CPI PCE prints, monthly. Big surprise, market volatility. Break-even inflation, 10Y tips versus nominal 10Y, market expectation. Wage growth, unit labor costs. Sticky wages hint persistent inflation. Commodity prices, oil, base metals, agricultural products. Money supply growth, M2 and credit growth. High growth can presage inflation. Central bank minutes and speeches. Forward guidance matters. FX moves and capital controls. If a country's currency crashes, inflation will follow. If 2 to 3 of these flash red, tighten risk. 11. Survival cheat sheet. What to do for traders and investors. Short, exact rules you can follow. 1. Don't keep excess cash in plain bank deposits if inflation's accelerating. Real return equals nominal minus inflation. 2. Shift to short-duration bonds, T-bills rather than long bonds when rates are rising. 3. Use inflation-protected securities, TIPS, or your country's equivalent to protect real purchasing power. 4. Wait into real assets, commodities, energy stocks, industrials. These often outpace inflation. 5. Own quality companies with pricing power. They pass costs to customers. 6. Reduce long-duration growth exposure if inflation risk rising. 7. Hedge with options if you fear a sudden shock. Buy puts on major holdings. 8. Diversify currencies if local currency looks fragile. 9. Limit leverage. Margin rates spike when central banks hike. Leverage plus inflation surprise equals kill zone. 10. Keep cash reserve dry powder to buy dislocations, but keep it small relative to inflation risk. Practical. Set a simple rule. If CPI prints consensus by X BPS 2 months in a row, reduce long-duration holdings by Y%. Number 12. Trade setups that often work during inflation regimes. Short long-duration bonds, or move to floating-rate debt funds. Buy commodity exposure, ETFs or select producers, but watch geopolitics and storage costs. Buy energy producers, have materials stocks, they can pass through prices. Buy real assets or real estate only if rents keep up with inflation. Otherwise, capex and rates can hurt. Consider small hedges using index puts if you hold high beta tech exposure. Number 13, mistakes that kill retail during inflation. Roasts. Kartikai holds cash and shouts, "I'm conservative," as prices eat his savings. That's not conservative. That's impotence. Sudhanshu keeps all money in one emerging market bond because headline yield is sexy. Then currency collapses and he learns pain. Crypto bras shout store of value, while BTC swings 50% in a week because it's not a stable hedge against real-world inflation for short periods. 14. Quick scenarios. What to do immediately when CPI bomb drops. 1. Pause new long-duration buys. 2. Trim high-valuation positions, growth stocks. 3. Increase cash in T-bills, short bonds for 3 to 6 months. 4. Buy small commodity hedges or energy exposure. 5. Check margin and capital, cut leverage now. Car. Number 15. Valhalla mic drop. Tattoo this. Open quote. Inflation is the silent thief that eats your past paychecks and leaves you wondering why your future is poorer. Respect it, hedge it, or be hunted by it. Close quote. Final quick checklist. Print it, stick it by your screen. CPI PCE date, mark it. Break-even inflation, watch daily. Wage growth and unit labor, check monthly. M2 and credit growth, check quarterly. Commodity basket, oil, base metals, food, monitor weekly. Margin, leverage exposure, always 2 gams unless pro. Cash buffer, 5 to 15%, depends on risk appetite.